Now, from the point of view of having, to say, properties within the trust that are making a profit. Now,
rental profit.
Rental properties.
Yep.
With regards to the profits being distributed, how can you receive, I guess, a tax benefit by having a trust, by, I guess, distributing these assets?
Yes, I'm with you. One very simple mechanism, crude, but effective. You distribute the rental profits, if there are any, after interest and depreciation and so on, you distribute that to a company. And you cap the tax rate then at the company rate of tax, presently 30%. Okay. Capital gains would then be streamed to natural person beneficiaries who get the 50% discount. And therefore the maximum rate of tax to an individual who receives a discounted profit will be 24.25.
Okay.
Which is less than 30. And of course, final distribution. A company who receives a distribution of income still one day has to make a distribution of its own to beneficiaries, and there'll be top-up tax of that.
Okay. And if you have a situation where, let's say you have two beneficiaries, one beneficiary has $1 million a year income,
yep,
and the other beneficiary has a $10,000 income.
Right.
Okay. From the point of view of distributing the, I guess, the profits, how can the trust help minimise tax from that point of view?
Okay. The most common answer is that the trustee exercises its discretion to give to the lower income earner a greater share of the profits of the $1 million earned by the trust. Generally, that's okay. In extreme cases, it might be subject to Part 4A, at least where there's been, Part 4A is a general avoidance rule, at least where there's been patterns of distributions going the other way or some non-commercial reason why it is now the way it is. Generally, that's an extreme case and unlikely to be encountered. So a distribution, an uneven distribution to beneficiaries, undertaken by a trustee who resolves to give to the lower income earner some supplementary income to make good the deficiency between them, then that will be successful. Okay. One more thing I would add here. So far we've been talking about a case where the trust has acquired a capital asset, that is, one whose appreciation will be assessable to capital gains tax. If instead the trust acquires trading stock or undertakes the development of units for sale at a profit, so it's not capital gains tax but just ordinary revenue profits, then in those cases you can still use a trust and the trust can distribute to companies. That's fine. It is necessary to avoid a provision in Division 7A to ensure that the trustee does not make payments, loans or advances or debt forgivenesses or any other benefits to people who are associates of the shareholders of the company. And what most people do is the trust making the distribution of the profit, the trading profit, the sale of units in this case, would distribute to an interposed trust who would in turn distribute to the company. So that the interposed trust, who's never before received any cash from the ultimate distributing trust, the head trust, could not be one of whom it is said has made advances, distributions, loans, forgivenesses and all those things to shareholders or their associates. That overcomes the problem. There is a new problem that, well, it's newly noticed, I think, by the Commissioner, and that is this, that the Commissioner is now looking to cases where, in a brand new ruling issued only last week, it says this, that if a distribution is made by a trust to a company who doesn't claim it straight away, then the company is making a loan to the trust. It's not a loan in law, But the definition of loan in Division 7A includes financial accommodation. So the Commissioner is saying that if that is not claimed in a short period by the company receiving it or whom it's entitled, then that company is making a loan and subject to Division 7A. Now, Division 7A is an awful set of rules, applies to companies, private companies, but deems them to have made unfranked dividends to the recipients of the loans to the extent to which they're not repaid at the end of the year, and loses franking credits for good measure. So it's paid tax on the distribution, but it'll lose the franking credits in a case like this. So distributions to trust, from trusts to companies, if it's a trading profit or even net rental income, matters not, so long as it's not capital gain. In those circumstances, there can be a number of other traps to avoid. It's for this reason that you generally suggest, if you're in doing trading, you're in a trading business, you generally use a partnership between a company and a trust. And the partnership profits derived by the partnership in the sale of units and dwellings and things would inure to the company as a share of partnership profits, but the cash be left in the partnership, or even the loan account, well, it's not to be called a loan account, but it's going to be part of the capital account of the trust, is overdrawn. Here, Division 7A is very difficult to apply in these circumstances because it hasn't gone through a trust to reach the company in the first place. So those rules in Division 7A have no operation. And so long as the character of the undrawn amount of partnership profits is treated as capital in the partnership accounting, it won't be a loan for Division 7A purposes. That's just a potted summary of a common way to get around it, still using a trust.
Campbell, in your opinion, what are the benefits of having a trust for an investor?
Flexibility is the most important one. Flexibility in that the investor can arrange his affairs in a way that is less prone to attack than other ways, or less likely to be subject to unanticipated and unintended tax consequences. Now, that's not to say it's plain sailing as a trust, but what the trust does have that companies don't have is the ability to pass through unrealised capital gains to the beneficiaries that a company cannot do, except by an unfranked dividend, and that's the worst of all worlds. And it has the ability to better match the principal beneficiary's expectations and belief of what he is doing. I say that because the principal beneficiary will often treat the trust as his property. And if it's his property, he will tend to do with it in a way that a trust will allow him to. Conversely, a company is not likely to have that freedom. A company often triggers a question in an investor's mind and say, well, if the company pays tax, why should I again pay tax on distributions? I've already paid tax, and that's often very hard for investors to understand. It's a two-tier system of taxing in this country, and it's quite difficult. So flexibility is the main thing for the trust. It is also a flexibility in that you allow distributions to family members. You can stream out unrealised gains if you do it carefully. We haven't touched on this yet, but the ability to stream out unrealised gains is a very big advantage of trusts. Companies cannot do it.
And also, what would be the advantage of having your assets in a trust as opposed to your own personal name?
Okay. Assets in a trust are separate from you, unlike if it's in your own name. And if it's separate from you, they're less prone to attack from creditors. An individual is unlimitedly liable of anything that turns up. Let's suppose the trust has a few assets, but it's incurred a big public liability debt to somebody, far more than the assets available to meet. In the case of a corporate trustee, that's the extent of the payment. Individual, it's unlimited. And so you really do have a cap on your liability measured by the extent of trust assets, if it's a trust, and a corporate trustee. As I've said, there's so many other areas of law. Now, the revenue law is being drawn on a basis of taxing transactions. Stamp duty is a classic example of this. But also capital gains tax. Sales of property, distributions of property, resettlements of trusts, and all those sort of things lead to capital gains tax events. Trusts are also very useful in the realm of owning assets in trust for measures of protection, but having the capital gains derived by other entities, not the owners of the assets. And that's much more readily done through trusts than companies. Company law imposes a dead hand over everything companies do, and the fiduciary responsibilities of directors of trustee company is quite a weighty thing to deal with. So if the company has its own assets, that is, it doesn't act as trustee, then so much the greater will be the risk to the directors. That's the real advantage trusts have over companies.
Okay. So Campbell, that certainly was informative, and thanks so much for making the time.
My pleasure.
Thank you.
Thank you.